So, welcome to Study Nexus. Today we are going to start with a chapter called Leases and Accounting Standards. Leases generally, Accounting Standard 19 deals with leases. This accounting standard is applicable to all entities. Partial exemption may be available for level 2, 3 or SMCA industries. First, what do you mean by lease? Lease means agreement between two parties. It is an agreement between two parties wherein the right of to use an asset, right to use of asset is transferred against consideration or a series of consideration. Series of consideration can be termed as installments. Leasee is a party. Leasee is a party who obtains right to use of an leasee is the party who obtains right to use of asset, and lessor is a party who receives consideration. Uh, leasee pays consideration to lessor. Leases are of two types: financial lease and operating lease. Financial lease means lease where risk and returns incidental to ownership. Here, ownership is also transferred in financial lease. Operating lease ownership is not transferred. How to classify financial lease and operating lease? There are criteria of classification of financial lease and operating lease. The first criteria is automatic transfer of ownership or at the end of lease terms. Automatic. What do you mean automatic transfer? At the end of lease terms, automatically the asset will be transferred to the lessee from the lessor. These are also generally termed as hire purchase agreements. Second point is purchase option is given by lessor to lessee at the end of lease terms at a very low price, that is nominal price, say rupees 100 or 1000, which must be lower than the actual value of the asset at the end of lease terms. Third point is where the lease term is equal to the life of an asset. If the life of an asset is 5 years and also the lease term is also for 5 years, then we can term it as financial lease. Fourth option is specialized nature of asset. Specialized nature of asset means the asset cannot be used by any other person except lessee. Lessee will for an example, hospital ambulances are only used for the purpose of taking patients from their home to hospitals, and ambulances are of no other use except for taking patients, carrying patients. PV, where PV of lease renters is equal to fair value of asset. This can also be termed as, this is also very important one, we will discuss it. So accounting treatment, first we will calculate the PV of minimum lease payments from the standpoint of view of lessee. From the standpoint of from the point of view of lessee, we will first calculate MLP of lessee. The MLP of lessee consists of two parts, that is agreed lease renters and guaranteed residual value. This is very important term, guaranteed residual value. Agreed lease rentals are uh, agreed payments except contingent rent, and contingent rent is not a part of agreed lease rentals. Contingent rent, what do you mean contingent rent? Contingent is amount payable based on any variables like sales, customers, or contingent rent is written off as an expense. It is an expense and it will be written off as an expense. Then we will bifurcate the amount of installment into two parts, that is principal part and that financial charges, based on applicable effective discounting rate given in the question. Then we'll pass there is general entries which we must have to pass in year 0. We pass two entries, that is asset taken on lease, down payment if we pay any down payment, or if we make any expenses. These three entries we have to pass. If we are taking asset on lease, then we are going to pass from the point of view of lessee. We're going to these entries are these are entries from the point of view of lessee. The entries we are going to discuss is from the point of view of lessee, and these are for year 0. First we will pass entries like asset on lease to lease liability lessor. Second, we can pass down payment. If we make a down payment, we are going to pass entries lessor account debit to bank. When if the lessee payments, the lessee makes any expenses on the behalf of lessor, then we are going to pass asset on lease account debit to bank. The year end, we are going to bifurcate the amount into financial charges and the principal part. we are going to charge depreciation, then writing of expenses through SPL. Some important points: value of asset is to be recognized, that is lower of fair value, or PV of MLP. If this line is very important, if lower value of if lower value, that is a fair value, if fair value is lower than PV of MLP, then we have to calculate IRR. This is very important, right? Here we have to calculate if fair value is less than PV of MLP. Basically disclosure, as per tax laws we have to also calculate DT and DTL. It's considered disclosure important are not so important. These are not so important. And we have to bifurcate the amount payable which is beyond 12 months, then we will show it as long term liability. And if it is if we are going to pay installments in upcoming 12 months, then we will show it as current under the head current liabilities, that is other current liabilities. For example, example one, we are considering Ram took one machine on lease whose fair value is 2 lakh. Fair value here is 2 lakh rupees, and agreed payment of amounts is lease rental. These are lease rental: 70,000, 65,000, 60,000, 35,000, and 22,000. 10% is the rate of interest, and 5 years the life of asset. The life of asset, that is machine, and tax rate is 30%. So first of all, we will calculate the MV of MLP. MV of MLP can be calculated as fair value is 2 lakh, and then lease rentals are 70,000. Lease rentals are 70,000, 65,000, 60,000 for year 1, year 2, year 3. We take out the PVs and we will calculate value of the asset. Value of the PV of MLP is less than fair value, then we will move on to step 2. If fair value is less than, then we must have calculated IRR. Calculation of financial charge. This we will calculate on the PV of MLP from the point of view of leasing, which we have calculated in step 1. Then we will charge interest at a rate of 10% on this amount. Installment is 70,000. We'll deduct the interest, and then we'll get the principal part. We'll deduct the principal part from the MLP, PV of MLP, and then we'll get this amount. Then we will charge interest on this amount. This is interest 10%. This is interest 10% charge on this amount. This is the installment. We'll deduct it, and we'll get this same. Then we will pass general entry, that is asset on lease. Asset on lease is this. We haven't paid any interest, we haven't paid any expenses. Down payment, these are down payment. This is entry of down payment, this is the entry of expenses. Then we will bifurcate in year 1. In year 1, Y1, we will bifurcate the amount financial charges and principal part we have calculated here. This is the principal part, and this is the interest, and this entry I have passed here. Then we will charge depreciation for 5 years. This is 5. It's 5. Then we will pass interest to as profit and loss, stream of profit and loss. We'll calculate the DTL. This is the financial charge. This is the interest which we have charged. We have bifurcated in step 2, and then these are the depreciation amounts we have, and this is the total. Now these are the installments which we have given, and the difference between this is this. We have is the financial charge, and depreciation charge is less than the amount we have given as an installment. Then we have to calculate we have calculated liability. Second, Also we have calculated the liability. Third, we have also calculated liability. Fourth year we have reversed liability. Reverse liability as this is as year 4 the total is more than the installments amount of installment paid, and so we have to reverse the liability from uh, amount of rupees 44,982 minus 35,000, that is 9,982 rupees. We have reversed the liability, and in year 5 we have reversed the whole amount of liability there. So DTL is less, is 0. Will pass for year 1. In year 1 will pass DTL SPL through DTL, that is 30%. SPL will show the expenses bifurcated into two parts. The depreciation we have calculated earlier under financial charges. Balance sheet will show under two heads, that is non-current liabilities and current liabilities. Non-current liability will be subdivided into two parts. Direct deferred tax liability of 3,500 we have calculated here. Um, calculated here and long-term liability will be divided as total value of the asset is 1,99,000. This is the principal part, and this is the amount which we are going to pay in upcoming 12 months, and we have shown this amount as here, that is other current liabilities. In the asset sides we have shown deducted the depreciation amount, that is depreciation amount of 39,989 from 199,947. I have deducted amount of depreciation, that is 39989. So we'll get this amount 1,59,958 rupees. This usual disclosure requirements are not important from examination point of view. These are general entries for year 2. I've made all the general entries. Let's take an example, second example. Here we are going to cover this guaranteed lease residual value. Fair value is 20 lakh, lease term is 5 years, lease rental is 5 lakhs, expected residual value of no use from lease point of view. IRR is 10-15%, depreciation rate is 10%, and we have to ascertain unearned income, financial income, and past necessary general entries. So computation. So we have computed PV of MLP as earlier. This then we will calculate the financial charges by computing the table. Then we'll pass general entries, and then we'll calculate unearned income like same as earlier. So that's all. We'll continue from the point of view laser in the next part.